Hi, thousands of UK property sellers could face unexpected penalties in 2026 because of HMRC's strict new 24-hour reporting rule. Here's exactly what you must know.
If you own a second home in the UK, or you're even thinking about selling one, listen up. That 60-day tax window you think you have, it's pretty much a myth. The reality for 2026 is that your real preparation deadline has been squeezed down to, well, effectively just 24 hours. So today, we're going to unpack exactly what that means for you, and more importantly, how you can stay ahead of the game. Let's get right into it. And just so you know, this entire guide comes straight from the expert tax advisors at My Tax Accountant. They're one of the UK's most trusted accounting firms, and they've put together this roadmap to help you navigate what are some pretty massive changes coming in 2026. So let's start with the big question, right? You're getting ready to sell a second property. You know there's going to be a capital gains tax bill coming your way. And you've probably heard that you've got this comfortable 60-day window after the sale goes through to get it all sorted with HMRC. Sounds pretty reasonable, doesn't it? Well, here's the new reality. That 60-day deadline, yes, it's technically still in the books, but honestly, it's dangerously misleading. The practical deadline, the one for having all your information, your calculations, your documents ready to go, that has been crunched down to, you guessed it, effectively 24 hours from the moment you agree that sale. Now, that might sound totally impossible, but stay with me here. This isn't just one single rule change. It's more like a perfect storm of new regulations. Everything from tax to digital record keeping to tenant rights, and they all demand that you are ready to act instantly. And this brings us to what we're calling the 60-day reporting myth. You see, the official deadline is deceiving because it completely ignores the mountain of prep work that now has to be done before that 60-day clock even starts ticking. A whole new web of compliance has been woven around property sales, creating this immense, immediate pressure right from day one. Okay, so let's be absolutely clear on the official HMRC rule. On paper, it says after you complete the sale of a residential property where tax is due, you have 60 days to file what's called a UK property return and pay an estimate of what you owe. For years, this felt like a really comfortable buffer, plenty of time to dig out receipts and have a chat with your accountant. But that buffer, it's gone. It's vanished. The old, relaxed way of doing things, completing a sale and then casually getting your paperwork together, that is just asking for trouble in 2026. The new system demands you're proactive, that you're ready in real time. And honestly, this is what catches so many people out, because they're still working on the old timeline. So where is all this new pressure actually coming from? Well, the first, and let's face it, probably the most painful factor, is the new capital gains tax squeeze. It's not just that you have to report faster, you're almost certainly going to be paying a lot more tax on any profit you make. Now just look at this slide for a second, because the change has been pretty stark. The higher rate for capital gains tax on property profits, it used to be 20%. Today, that rate is 24%. Now that is not a small tweak. It's a really significant jump that takes a much bigger bite out of the profit you make from your sale. And it doesn't stop there. The amount of profit you can make each year completely tax-free, that's called the annual exempt amount, has been absolutely slashed. As you can see, it now stands at a tiny £3,000. Just to put that into perspective for you, a few years back, it was over £12,000. So that tax-free buffer you might have been counting on, it's now incredibly small, which means way more of your gain is now taxable. Let's make this simple. Let's look at a real-world example. So meet Aisha. She's a shop owner in Birmingham, and she's a higher-rate taxpayer. She sells a rental property and makes a profit, or a gain, of £100,000. Now, in the past, her tax bill would have been much more manageable. But look at these numbers for 2026. With that higher 24% rate and the tiny £3,000 allowance, her tax bill is significantly bigger. The key thing here is this is thousands of pounds more in cash she has to find and pay to HMRC within that tight 60-day window. It's a huge cash flow problem waiting to happen. So here's my tip for you. Please do not wait until you've accepted an offer to figure this stuff out. Calculate your estimated capital gains tax bill before you even put the property on the market. Honestly, knowing that number from day one completely changes your mindset. It helps with your negotiations, it helps you set a realistic sale price, and it makes sure you're not scrambling for a huge pile of money at the very last minute. It is the absolute foundation of being prepared. Now, this pressure to be prepared isn't just about the moment of sale. For landlords, the whole ongoing compliance world has also been turned upside down by the arrival of Making Tax Digital. By 2026, You're not just a landlord managing a property. HMRC expects you to be a digital landlord, constantly managing real-time data. So why exactly is Making Tax Digital, or MTD? Well, from the 6th of April 2026, if you're a landlord and your gross rental income is over £50,000 a year, you have to use it. It's a new system that means you have to keep all your financial records digitally, using special software, and you have to send financial updates to HMRC every single quarter. Yep, the days of the annual tax return are coming to an end. And this just brilliantly illustrates the new process. First, all your records, they have to be digital. That old shoebox full of receipts, that is no longer an option. Second, you have to send these quarterly summaries of your income and expenses directly to HMRC, which means your finances are constantly visible to them. And third, you still send a final declaration to wrap it all up. This creates constant, real-time oversight. Think about it. The taxman is no longer this distant figure you deal with once a year. They're a constant digital presence in your business. Okay, let's break this down even further. Because this whole 24-hour pressure isn't just about capital gains or MTD. It's coming from a much wider compliance web that stretches way beyond tax and right into the day-to-day running and sale of your property. Just look at how all these pressures overlap and build on each other. You've got that tight 60-day CGT window. You've got the quarterly MTD submissions. But on top of that, your solicitor needs instant anti-money laundering checks cleared. Any delay there can put the wholesale at risk. Then there are new rules under the Renters' Rights Act that could force you to fix serious hazards within 24 hours. And all the while, you could be facing these punishing council tax premiums. It all just adds up to this constant state of needing to be ready for anything. And here's a startling fact that just shows how much the ongoing costs are shooting up. Did you know, in some parts of the UK, like Edinburgh, local councils can now charge a 200% council tax premium on second homes. That's triple the standard rate. It's a policy meant to help with housing shortages, but for owners, it's a massive financial drain that just adds another layer of pressure. And this quote just sums it all up perfectly, doesn't it? In 2026, owning a second property, it's just not a passive, hands-off investment anymore. This new world requires you to be a proactive, hands-on compliance manager, constantly juggling money, legal rules, and regulations in real time. Okay, so we've laid out all the challenges. How do you actually prepare for this? You'll definitely want to hear this part. The key is to stop being reactive. You need a clear, preemptive action plan in place long before you're even thinking about a sale. Here is a simple 5-step action plan to get you ready. Number 1, get a formal valuation so you know your property's current market value and potential gain. Number 2, as we've said, calculate your estimated capital gains tax now. 3, start gathering all your records digitally, purchase price, invoices for improvements, any letting expenses. 4, take a look at your ownership structure. Is the property held in the most tax-efficient way possible? And number 5, probably the most crucial step of all, engage a professional tax advisor at the very beginning of your planning, not at the end when the clock is ticking and the pressure is on. So, as we start to bring all this together, let's just nail down the single most important message you should take away from our conversation today about handling property in 2026. The crucial point is this: the era of looking back, of relaxed compliance, is well and truly over. Waiting until after something has happened to sort out the paperwork is a recipe for stress and fines. The new standard is real-time readiness. Your records, your calculations, and your strategy, they have to be ready to go at a moment's notice. So the real question isn't if you need to adapt, but are you prepared to start today? Now, it's absolutely essential that I state this clearly. The information we've covered today is for general guidance and is really just designed to get you thinking. Tax law is incredibly complex, and of course, your personal situation is unique. So please do not act on this information without first talking to a qualified professional advisor. To navigate all these new rules with real confidence and build a plan that's right for you, the experts at My Tax Accountant are ready to help. You can get in touch with them directly on 0208-570-8531, or you can drop them an email at info@mytaxaccountant.co.uk. For more essential updates just like this one, please do remember to subscribe to the channel. Thanks so much for watching.